Looking at my screen here, and I see David Bailin, CIO at Citi Private Bank in the Hangout. David, good to have you on this morning on this jobs report Friday. So listen, you've digested the numbers, not pretty. 14.7% unemployment rate, 20.5 million people have lost their job or lost their job last month. Where do you put money to work in this type of backdrop?
The numbers that we just saw, while very, very high, are very much what we would have expected given all of the data that we've had for each of the last 4 weeks. So we have to look at what that actually means. About 2/3 of the job losses are really in three sectors, related to recreation and leisure, related to restaurants and those types of jobs. And for the most part, there are benefits, wage benefits and unemployment benefits associated with people that are unemployed through the end of the year. So while the numbers are very severe, the programs that the government has put in place are actually going to be highly effective in helping those people, through the end of December. In terms of putting to money and work in the markets, that's a different story, because when you take a look at this market, it is really, really differentiated between the leadership of the market, which is tech-driven, the top 30 stocks, and the rest of the market, where we actually see in the small and medium-sized companies price differentials of 25%, even 30%. So what we're doing is we're realigning our client portfolios to those small and medium-sized companies that are going to do better in 2021 than they certainly are going to do in the market right now. There are other areas that we like as well, but a lot of those are recovery trades. But for the most part, we're moving away from the index and into specific subsectors within the market.
Hey, David, Alexis here. What do you do with a market that is so highly overvalued? Some people are saying we're 50% overvalued versus earnings, and we haven't even gotten Q2 numbers yet, which are supposed to be worse than Q1. So how do you position a portfolio, or do you hold on to more cash than you normally would?
So I'm going to challenge that idea. I think that what we could effectively say is that the stock market normally looks out 6 months and now potentially is looking out to 2021. So the market is priced in an unbelievably bad Q2, right? A really sharp decline in GDP, which we think could be 35 or 40%, and is then looking to the third quarter to see a very bungee cord snapback of the economy, where, just as an example, about half the people who were unemployed right now would become reemployed by September 30th. And if those two things occur, then the market then will begin to look at 2021 earnings. We think that 2021 earnings are going to be 15 to 20% below peak earnings in the market, and that would make the market expensive, but not wildly overvalued or 50% overvalued. That is really a lot of hyperbole, because unlike a normal recession, this is a situation where the externality, the virus itself, has caused it. The government has responded to it in terms of providing support payments for the population that I talked about. And now the question is, how fast do things snap back? Certain industries, for example, manufacturing of dishwashers or manufacturing of capital goods, are going to snap back to 100% of what they were before. Other industries like automobiles may snap back less than that. Housing, to a degree, will snap back more slowly. Things where you actually have to travel will snap back more slowly. So what we've projected is that it'll take about 2 years for the economy to reach where it was in the first quarter of 2020. But markets know everything that I just said. The question is, does that actually occur? Or is there an impact from something that's unexpected? For example, a marked worsening of the pandemic or some other economic impact that we don't anticipate that could derail us. So what I would say is that markets are only expensive if that recovery doesn't occur, or if people somehow doubt the Fed's resolve to support parts of the market to ensure liquidity and things like that, which I think would be a very foolish bet right now.
I know, David, the market, well, I certainly know well too, it's forward looking. And to your point, 6 months forward, the U.S. economy and global economy will look a lot different than it does today. People will be back at work. They'll be making more money likely than they are now. Would you be surprised if the S&P 500 rallied another 15% into year end?
I would be surprised. I would be happy and surprised if that were true. I do think that that the market is far more selective than the indices indicate. So if you look at small and medium-sized companies, if you look at insurance companies, if you look at banks, if you look at automobile manufacturers, and you ask yourself, are these companies properly priced given what you and I have just discussed, what we've just discussed? The answer is they probably are, right? They're significantly under where they were before. The companies that are at or above where they were before are companies that are net beneficiaries of what's taken place. Their businesses have been accelerated by what's happened, right? So anything that's digitization, anything that's taking place at home, the delivery of entertainment, all of those areas that one would expect to have done well are doing well. So in my mind, that's what's different from this recession versus the great financial crisis. When you look back, technology went down with everything else in the great financial crisis of 2008, 2009. Right now, tech is doing the exact opposite. It's leading us into the future. And so I think the destruction is going to take place about companies that don't have sufficient capital to get from here to there. And that's going to be a real drag on the economy. But similarly, there are going to be a handful of companies and industries that are clear winners and beneficiaries. So that also should speak to where your portfolio is. You want to continue to own those, but you want to then tilt your portfolio to those companies that are going to take a year or a year and a half to recover from here.
All right, well, let's leave it there. David Bailin, CIO at Citi Private Bank. Let's hope that the S&P 500 does go up 15% into your end.
I would be very happy as an investor, and I hope you are too. Thanks so much for having me today.
You and me both. Have a good weekend.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.